Why are there not more people talking about the history of money before Bitcoin? Before Bitcoin, people dreamed of digital cash. The idea of a currency that could be sent over the internet, just like an email, was a tantalizing prospect. Imagine a world where money could move as quickly and effortlessly as information. They wanted a way to send money online, like sending emails. This vision was not just about convenience, it was about creating a new kind of financial freedom, unbound by traditional banking systems and geographical limitations. Many tried to create digital currencies. However, they all failed. These systems had flaws. The early pioneers faced numerous challenges, from technical limitations to security vulnerabilities. They were easy to hack. Security was a major concern, as hackers could exploit weaknesses in the system, leading to significant financial losses. There were problems with double spending. This issue, where the same digital token could be spent more than once, undermined the integrity of these early digital currencies. Centralized control was another issue. Many of these early systems relied on a central authority to manage transactions, which made them vulnerable to corruption and failure. Digital cash remained elusive. Despite the best efforts of many brilliant minds, a truly viable digital currency seemed out of reach. In the 1990s, several notable attempts emerged. These projects laid the groundwork for future innovations, even though they ultimately did not succeed. DigiCash, founded by David Chaum, offered privacy-focused digital currency. It was a revolutionary idea at the time, promising to protect users' identities while enabling digital transactions. However, it relied on a central authority. This reliance on a single point of control ultimately proved to be its downfall. eGold, created by Douglas Jackson and Barry Downey, used real gold as backing. This gave it a tangible value that many other digital currencies lacked. However, it faced regulatory challenges. Governments around the world were wary of this new form of money, leading to legal battles and restrictions. These early efforts highlighted the difficulties of creating a viable digital cash system. The technical, regulatory, and security challenges were immense. Despite these setbacks, the desire for a decentralized, secure, and anonymous form of online payment persisted. Innovators and visionaries continued to explore new ways to make digital cash a reality. The pursuit of a truly functional digital currency continued in online communities and academic circles. These discussions and collaborations kept the dream alive, even as early attempts failed. The stage was set for a breakthrough. The world was ready for a new kind of digital currency, one that could overcome the challenges of the past and pave the way for a new financial future. In 2008, everything changed. The world was plunged into a financial crisis that shook the very foundations of the global economy. Banks were failing, markets were crashing, and trust in traditional financial systems was at an all-time low. Amidst this chaos, someone using the pseudonym Satoshi Nakamoto published a groundbreaking paper. This paper would lay the foundation for a revolutionary new form of currency. It was titled Bitcoin, a peer-to-peer electronic cash system. This document proposed a radical shift in how we think about money and transactions. This paper described a new kind of digital money. It was called Bitcoin. Bitcoin was different. Unlike traditional currencies, it wasn't controlled by any central authority. It didn't need banks or governments to operate. This was a decentralized form of currency, free from the control of any single entity. It used cryptography to secure transactions, ensuring that each transaction was both transparent and secure. It relied on a decentralized network of computers known as nodes to validate and record transactions. This network is known as the blockchain. The blockchain is a public ledger that records all Bitcoin transactions. In 2009, the first Bitcoin was mined. This marked the beginning of a new era in digital currency. The world met a new form of money. Bitcoin was not just a currency. It was a statement against the flaws of the traditional financial system. The creation of Bitcoin marked a turning point. It was a bold experiment that challenged the status quo. It offered a viable solution to the challenges that plagued previous attempts at digital cash. Issues like double spending and centralization were addressed in innovative ways. Bitcoin's decentralized nature, coupled with its cryptographic security, made it a compelling alternative to traditional financial systems. It promised a future where financial power was distributed among the people. The birth of Bitcoin ushered in a new era of financial innovation. It opened the door to countless possibilities and set the stage for the future of digital finance. The blockchain is the technology behind Bitcoin. Imagine a digital ledger. It records every Bitcoin transaction. This ledger is copied across many computers. These computers are part of the Bitcoin network. When you send Bitcoin, the network verifies the transaction. It adds the transaction to a block. This block is added to the blockchain. This makes the transaction permanent and secure. The blockchain ensures that no one can spend the same Bitcoin twice. The decentralized nature of the blockchain makes it resistant to censorship and manipulation. Each participant in the network has a copy of the ledger, making it difficult for any single entity to control or alter the transaction history. This distributed consensus mechanism lies at the heart of blockchain's security and resilience. After Bitcoin, things moved quickly. Thousands of other cryptocurrencies emerged. These are known as altcoins. Some, like Ethereum, introduced new features. Ethereum allows for smart contracts. These are agreements written in code. Other cryptocurrencies serve different purposes. Litecoin aims to be faster than Bitcoin. Ripple focuses on cross-border payments. The crypto world became a diverse ecosystem. Each project had its own goals and technology. The emergence of altcoins led to an explosion of innovation in the cryptocurrency space. Developers experimented with new consensus mechanisms, privacy features, and applications beyond simple money transfers. This period of rapid growth and diversification broadened the scope of what cryptocurrencies could achieve. Cryptocurrencies offer several potential benefits. Transactions can be faster and cheaper. This is especially true for international payments. Cryptocurrencies can be more private than traditional banking. They give individuals more control over their money. For some, cryptocurrencies represent a break from traditional finance. They offer an alternative to banks and governments. These factors have attracted investors and users worldwide. The decentralized nature of cryptocurrencies holds the potential to disrupt traditional financial systems. By eliminating intermediaries, cryptocurrencies offer faster transaction speeds, reduced costs, and increased transparency. Moreover, cryptocurrencies empower individuals by giving them direct control over their assets without relying on centralized authorities. The risks remain: volatility and scams. Investing in cryptocurrencies comes with risks. While the potential for high returns can be enticing, it's crucial to understand the inherent dangers. Prices can be extremely volatile, often experiencing dramatic swings within short periods. This means they can go up or down very quickly, sometimes within minutes or even seconds. This volatility makes cryptocurrencies risky investments, as the value of your holdings can change drastically in a very short time. The crypto world is also full of scams. Fraudsters are constantly devising new ways to deceive investors. Criminals use phishing and fake projects to steal money. They create convincing websites and emails to trick you into giving up your personal information or investing in non-existent projects. It's important to be cautious when investing in cryptocurrencies. Always be on the lookout for red flags and warning signs. Always do your research before investing. Look into the project's white paper, team, and roadmap to ensure its legitimacy. Never invest more than you can afford to lose. The high-risk nature of cryptocurrencies means you should only invest money that you can afford to part with. The lack of comprehensive regulation in the cryptocurrency market creates opportunities for fraudulent activities. This regulatory gap can make it difficult to recover lost funds. Investors need to be wary of Ponzi schemes, pump-and-dump schemes, which involve artificially inflating the price of a cryptocurrency to sell at a profit, and fake initial coin offerings or ICOs. These scams promise high returns but often leave investors with nothing. It's crucial to conduct thorough due diligence, verify project legitimacy, and ensure that the team behind the project is credible and transparent. Be skeptical of unrealistic promises of high returns. If something sounds too good to be true, it probably is. Always approach with caution and make informed decisions. Governments around the world are taking notice of cryptocurrencies. They are working on regulations. These regulations aim to prevent illegal activities. They also seek to protect investors. Some countries are more crypto-friendly than others. Some have banned cryptocurrencies altogether. The regulatory landscape is constantly evolving. This uncertainty creates challenges for businesses and investors. The evolving regulatory landscape introduces uncertainty for both individuals and businesses operating in the cryptocurrency space. Governments are grappling with how to classify and regulate cryptocurrencies, with approaches varying widely. This patchwork of regulations creates challenges for cross-border transactions, business operations, and investor protection. The future of cryptocurrencies is uncertain. However, the technology continues to evolve. Some believe cryptocurrencies will become mainstream. They envision a future where we use crypto for everyday purchases. Others are more skeptical. They believe cryptocurrencies are a bubble. They predict the market will eventually crash. Only time will tell what the future holds for cryptocurrencies. Despite the uncertainty, the potential impact of cryptocurrencies on various industries is undeniable. Blockchain technology, which underpins cryptocurrencies, has the potential to revolutionize sectors such as supply chain management, healthcare, and voting systems. As the technology matures and regulatory frameworks become clearer, we can expect to see further integration of cryptocurrencies and blockchain technology into our daily lives. Cryptocurrencies are a fascinating new technology. They offer both potential benefits and risks. If you're considering investing in cryptocurrencies, do your research. Understand the technology. Be aware of the risks. Invest responsibly. The cryptocurrency market is still young and volatile. It's crucial to approach it with caution. Don't let hype or speculation cloud your judgment. Remember that past performance is not indicative of future results. Invest only what you can afford to lose. The world of cryptocurrencies is complex and constantly changing. By staying informed, managing risks, and investing responsibly, individuals can navigate this exciting new frontier in finance and technology. We'd love to hear your thoughts on cryptocurrencies. Share your opinions in the comments below.